Hello everyone, today we're going to discuss problem scenario for subject Macroeconomics, code subject DPB20033, lecturer Encik Muhammad Hashim bin Ahmad. Before that, let me introduce our members. My name is RUSYDINA HUDA BINTI RUSLI, matrix number 08 DPI21F2019. Together with SHAZWANI DEANNA binti AHMAD ZAINUDDIN, matrix number 08 DPI 21F2017, NORSAFIKA binti AHMAD HALIL 08 DPI 21F2061, and lastly SHAZWANI ATILA binti IDRIS, matrix number 08 DPI 21F2033. Question number 1. Interpret the monetary policy and overnight policy rate OPR in general. The monetary policy, or known as financial policy, refers to a policy which employs the central bank's control of the supply of money as an instrument for achieving the objectives of the general economic policy. A monetary policy may aim to achieve the optimum level of employment and output, price stability, balance of payment equilibrium, or other goals of the government's economic policy with the regulation by the central bank. The central bank influences the cost of credit primarily by affecting the cash reserve of commercial banks in the economy.
Two types of monetary policies. There are two types of monetary policies practiced by a government. The government may choose to adapt either the expansionary type or the contractionary type depending on the circumstances of the situation. The expansionary type is aimed at increasing money supply to reduce unemployment, and contractionary type at reducing money supply to control inflation.
Okay, now, what is OPR? Overnight policy rate, or OPR, is an interest rate or profit rate at which a bank lends from immediately available funds to another bank overnight. It is determined by Bank Negara Malaysia in the Monetary Policy Committee meetings held throughout the year. Most banks will lend out as much money as possible in terms of loans whilst maintaining the minimum cash required by Bank Negara.
On 8 September, the Monetary Policy Commitment MPC of Bank Negara Malaysia (BNM) increased the PR by 2.5% in line with expectation for further normalization of the monetary policy as the nation's economic growth and inflation fall. The OPR height coincides with improvement in Malaysia's expectation for GDP growth in 2022. With the Bloomberg consensus prediction reaching to 6.8% in August. According to the statement from BNM, the MPC is not following any plan and will keep evaluating the effect of changing circumstances on the forecast for domestic inflation and GDP.
Now, for the final question, question 3. How firms or households will be impacted by the rise of OPR? OPR has a direct influence on a bank's base rate (BR) and base lending rate (BLR) as well as the standardized base rate (SBR). So, an increase in OPR would mean that the banks will increase the base lending rate (BLR) and base financing rate (BFR). which will have an impact on a bank's interest rate. This means it will increase in monthly installment payments, the repayment period will become longer, loan tenor will increase if the monthly installment amount is maintained, and interest earnings from savings and fixed deposits will also increase. Pros. First, lower OPR rates can lead to lower housing loan interest. Number 2, lower OPR rates can lead to lower fixed rate and also interest rate. Number 3, lower OPR means banks are less cautious about lending. Cons. Changing rate means changing the economic conditions that impact property markets. Number 2, it takes a long time to fix rate home loan to adjust.
OPR is always changed over the time. When higher the OPR is set, the more expensive is it to borrow money. If it costs more to lend, less people can do it. That can have a notable effect on the housing sector. Being an M to the OPR may have effect on interest rate charged on variable home loans. Variable loans will adjust rapidly than fixed rate loans, and realistically, a long period of lower interest rate is often required before any significant shift in fixed rate loan reflect.